So let's talk more about fuel prices then. As we've heard, they seem to be creeping up at the moment. And on the text, Liz in Rillington says petrol prices in her area at the moment are around £1.23.4 pence. I know that along Tadcaster Road in York, there are 3 filling stations in the space of about a mile, and there's a 10 pence a litre difference in the prices. So let me know where the bargain fuel is where you are. 81333. Start your message with the word York. Before the travel news there, we heard from Nicole Shepherd, who works as a carer in the Rickle area. And we've heard about the impact rising fuel prices are having on her personal finances. Well, what about the wider impact on other businesses? There's a company in York called Portland Fuel, and it allows businesses to buy fuel in advance at fixed prices. Their commercial manager, Patrick Smith, joins me this morning. Morning, Patrick.
Morning, Julia.
So fuel prices, they're always changing, aren't they? How does that affect people trying to run a business?
They certainly are, Julia, and the change in fuel prices largely depends on how you pass that cost on to the end user as a business. So if you take a haulier or a courier company, some form of transport company, they might have what's called a fuel escalator. So what's worked into their rate that they charge their customer is a clever clause that says if the price of diesel goes up, our rate goes up. And conversely, if the price of diesel goes down, our rate follows that. But if you take a bus company or perhaps a company that has their own fleet and runs long-term contracts where they can't easily pass the cost on, it's a lot more difficult for those sorts of companies. So with the example of a bus company, they set their ticket prices maybe 2-3 years in advance, and they need to know what price diesel will be in order to make sure they meet budget and keep their business profitable. In terms of mitigating those costs, you touched on it then, certain processes called diesel hedging, fuel hedging. That's a way in which people can fix their fuel costs in advance. It's not suitable for everyone, but for a bus company or a company running their own fleet where they have long-term contracts, this is a way that they can make sure they fix their costs and meet budget and keep their business profitable.
And so you take on the risk then?
Of sorts. It's using financial instruments in which we go to the market, we get a price, and we make sure that we're passing that fixed price on to the end user. With
companies like we've heard in the news about Carillion this week, and they're operating at very, very tight profit margins. And when you're talking about something like fuel, which it can be a massive, massive cost for businesses, what kind of impact can it have on a company that's having such a tight profit margin?
Well, you're exactly right. I'm not quite sure in the case of Carillion. I think there may be other things at play there. But if you take a company, Palmer and Harvey, that have recently gone into administration, they were running very long-term contracts, as I mentioned, running their own fleet. Particularly hostile competitive environment. As the fuel price has gone up, their contracts have become less profitable, and they're therefore gone into administration. So
ultimately, businesses are going to go bust, aren't they? We heard, a couple of years ago about prices going. Well, it was about 5 years ago. Prices going way up to £1.40 and prices like that. Is that likely to happen again? Is that on the cards?
The market conditions are slightly different to what they were a few years ago. Largely, it comes down to supply and demand in the oil markets. So 5 or 6 years ago, what we had was demand was higher than supply. So in what I mean there is we needed more oil than was available to us. What we've seen from sort of 2014 in the summer, where we got down to the lows of $30 a barrel for Brent crude in December 2015, which you touched on before, was that supply was larger than demand. So we had more oil available than what we needed. In recent months, we have seen these two market forces, supply and demand, come more into balance as OPEC, the Organisation of Petroleum Exporting Countries, bit of a mouthful, have restricted their supply. So that has meant that prices have been supported because there is less oil available, and we are continually needing more oil in the world. In terms of future trends, it largely depends on supply. If OPEC decide to turn the taps back on, we'll have more oil coming back to the market, and therefore we could see markets cooling off a little bit. But if they continue to cut and restrict their production, we could see prices continue to increase.
Well, let's hope we don't. Thank you very much. That's Patrick Smith, the commercial manager from that interesting company in York, isn't it? It's called Portland Fuel, which allows businesses to buy fuel in advance at fixed prices.